when they holds more than 51% of share. I'm saying just 51, it may be 60%, it may be 70%. Whatever the reserve available is called pre-acquisition reserve or capital reserve. Whichever is more should be shown on the, if there's a goodwill is more, it will come on the asset side of the balance sheet. If the capital reserve is more, it will come on the liability side of the balance sheet. Both should not appear in the balance sheet. Hello, my dear student. I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Grade College, a Temple of Excellence of MYSURU. I am going to hand Corporate Accounting 2, 4th semester, Unit 4, Session 1 in favor of BCom Holding Company. In the last session, or in we say that in the last year, I handled the Corporate Accounting 1, where we have got issue of share, redemption of debenture, redemption of preference share, liquidation, and stock option. This time, the corporate accounting contains the major ideas of general insurance, life insurance, holding company, and monetary benefit, inflation accounting, everything there. So we go on detailing about the corporate accounting this time. Introduction to holding company. Just I give the introduction and I will explain very, very detailedly. Holding company means a company holds the other company by purchase of the majority shares of such company. If there are two companies, one is called H company, another is called the S company. Assume that if there are two companies, one is called H, another is called S company. So holding company, which is going to be purchase more number of shares of more than 50% of the shares of the subsidiary company. So H is called holding company, S is called subsidiary company, which purchases more than 51% shares of the subsidiary company, then H is called holding company, S is called subsidiary company. Here the same word, other company, by purchase of the majority shares of subsidiary company. Number 1, small, which holds directly or indirectly. It may be directly connected or indirectly connected more than 50%. What is most important? More than 50% of the shares of another company. So H company purchase more than 50% of shares of the another company. So H is called holding company, S is called subsidiary company. Then, which contributes the other company by having majority votes. The majority votes goes in favor of H company. The minority votes goes in favor of subsidiary company. I will repeat. When the holds more than 51% of share, I am saying just 51, it may be 60%, it may be 70%, but more than 50% of share is held by, so more voting goes to holding company, less voting rights goes to minority. Then, which controls the board of directors of another company. So H company control the board of directors of subsidiary company. Whatever the subsidiary company is there, the board of directors is controlled by holding company because it purchased the major shares of the subsidiary company. So full control, holding company has got a full control about the board of directors of subsidiary company. I will repeat. A holding company is one which holds more than 50% of the shares of other company. Other company becomes the minority company. The company which purchases is called holding company. Then, which purchase directly or indirectly more than 50%. That point is most important. Second one, which contributes the other company by having the majority voting right. The majority voting right goes in favor of holding company because it has got a more number of shares. Then, which controls the board of directors of another company. The board of directors of subsidiary company is controlled by the holding company because majority share has been purchased. Hope so you understand this point. Then, what are the advantages of holding? What are the advantages? Easy to control the other company. When you have a more number of share purchase, it is very, very easy to control by holding company. Easy to avoid competition. There is no competition because that company. So previously there is a competition between H company and the S company. When they combine together, become one company, the competition has been abolished, has been vanished now. So there was a competition between the H company versus S company. Now, when the H company takes over the S company, they become one and the same. The question of competition does not arise at all because they become one and the same. So, this is over. Easy to make own policies. Now, when they become one and the same, it is very, very easy to make the own policies, easy to increase the amount of capital. So, we can increase the amount of capital because the capital of H Limited, the capital of S Limited combined together and the capital has been increased now. So, what are the advantages? Easy to control the other company, easy to avoid the competition of the two companies, easy to make their own policies because they are under one control of holding the company, easy to increase the amount of capital because both the company combine together and form one company, the capital naturally increases. Hope so you understand this point. Now I am going to explain about capital and reserve. I am going to say that what is capital reserve, what is a capital profit, what is pre-acquisition profit, post-acquisition profit, pre-acquisition reserve and post-acquisition reserve. So the word capital profit or pre-acquisition profit or before acquisition is called capital profit. At the time of acquisition, whatever the profit available is called pre-acquisition profit or capital profit. Whatever the revenue profit available or revenue profit or post-acquisition profit or after acquisition is called revenue profit. Before acquisition is called capital profit. After acquisition is called revenue profit. So, capital reserve or pre-acquisition reserve before, at the time of acquisition, whatever the reserve available is called pre-acquisition reserve or capital reserve. Whatever the reserve available, revenue reserve or post-acquisition reserve earned after acquisition. After acquisition is called revenue reserve is called. Reserve after it is called revenue reserve. So, before acquisition, capital profit, after acquisition, revenue profit, before what's called regarding the reserve is considered, at the time of acquisition, reserve is there, it is called capital reserve. After acquisition is called revenue reserve. Which are the four wordings are? One is called capital profit, revenue profit, capital reserve, revenue reserve. Whatever the profit earned before acquisition is called capital profit. Whatever the profit earned after acquisition is called revenue profit. Regarding the reserve, at the time of acquisition, whatever the reserve available is called capital reserve. Whatever the reserve available after acquisition is called revenue reserve. These are the four important points to be bear in mind before solving the problem. Minority interest means subsidiary company interest. Subsidiary company interest. It is the interest of the outsiders, or other words, it is a fund relating to outsider, means subsidiary company. It is less than 50% of the share because major share goes in the favor of holding company. It includes share capital, capital profit and revenue profit. So it goes in favor of, they will have got share capital, they have got their share of capital profit, they will have got share of revenue profit. There is one formula for that. This is the minority interest. How to calculate this is for 5 marks. See that face value share held by them, minority held by them, add their share of profit, add their share of reserve, whatever the reserve they have got, their share of assume that the company has got 5,000 share, 3,000 acquired by H Limited, the balance 2,000 goes to S Limited, the share value is rupees 100. Assume that. So, H is to S, 3,000 is to 2,000. So, they are in the ratio of 3 is to 2. We can say that 3 by 5, holding company, 2 by 5 goes to subsidiary company. Holding company has got 3 by 5 share, minority has got 2 by 5 share. Here the word is face value the share held by them. How many share they held? 2,000 into 100 is 2 lakh. Their share of profit, 2 by 5 of the total profit. Their share of reserve, 2 by 5 of reserve. Profit on revaluation if the asset have been increased by chance building, valuing 10,000. Now, valuing 15,000. How much more? 5,000. Profit on revaluation, 2 by 5 of 15,000. Loss on revaluation account by charge machinery, 10,000. Today valuing rupees 8,000. How much has come down? 2,000. 2,000 on 2 by 5. That goes to minority interest. This will come on the liability side of the balance sheet. I will repeat. First one, face value held by the subsidiary company, their share of profit, their share of reserve. If there is any profit on revaluation, that's appreciation. Loss on revaluation, this is called depreciation. So this goes to minority interest, appears on the liability side. Of balance sheet. So it will appear on the liability side of the balance sheet. So this will come from the examination of point of finance question. First you have to write what is minority interest. It is the interest of the outsider, or other words, it is a fund relating to outsider. It is less than 50% of the share. It includes share capital, capital profit, and revenue profit. This format you have to write. Face value of the share held by them, their share of capital profit, their share of reserve, profit on revaluation. If there is a depreciation, means loss on revaluation, it's a minority interest, it will appear on the liability side of the balance sheet. Then, goodwill or cost of control, excess amount paid by holding company for equity shareholder of subsidiary company over the paid up value is called goodwill. Assume that the company is taking 3,000 share. So H company is taking the 3,000 share. The share value is rupees 3 lakh. So 3 followed by 50. So they have to pay 3,000 share into 100, 3 lakh they have to pay. But they paid about 4,50,000. How much paid more? 1,50,000, which is called as goodwill. Your cost of investment, they paid how much money? 4,50,000 for how many share? For 3,000 share. Holding company paying 4,50,000. But real value is only 3 lakh. How much paid more? 1,50,000 is called goodwill. Then, excess amount paid by holding company to preference shareholder of the subsidiary company is also called goodwill. So this is in the case of equity share, this is in the case of preference share. If the holding company pays preference share more than face value, it is called goodwill. Excess amount paid by holding company over the value of debenture also goodwill. Whatever the debenture available for them, if they pay more, it's a goodwill to the what's called a subsidiary company. So if they pay more, it is a what's called goodwill to the subsidiary company. If they pay less, it is a capital reserve to the holding company. So instead of 3 lakh, by chance if they pay only 2,80,000, 20,000 is called cost of control or capital reserve, we say. The real value is 3 lakh. Holding company pays only 2,80,000. Difference is 20,000. It is called capital reserve or cost of control. So goodwill will appear on the asset side of the balance sheet. Capital reserve will appear on the liability side of the balance sheet. Once you find out the goodwill, calculate the capital profit. I will explain now. Here, cost of investment by holding company minus face value share held by subsidiary company, excess is called goodwill. Then, if capital profit, capital reserve, appreciation of asset minus division of capital loss, this is a capital profit minus capital loss, capital profit minus capital loss. If the goodwill is more than the capital profit, the result is goodwill, which appears on the balance sheet asset side. If the capital profit is more than the goodwill, it is called capital reserve, appears on the liability side of the balance sheet. So once you calculate the goodwill, you go with the capital profit, capital reserve, appreciation of asset minus depreciation, capital profit minus capital. So depreciation is a capital loss, capital profit, capital reserve, appreciation is a capital profit, depreciation capital loss. If the goodwill is more than the capital profit, then it will appear on the asset side of the balance sheet as a goodwill. If the capital profit is more than the goodwill, it will appear on the liability side of the balance. But you must make sure that both should not come in the balance sheet. That is, goodwill and capital reserve should not appear in the balance sheet. Either the goodwill or the capital reserve, whichever is more. I will repeat, in the balance sheet, you have to show either the goodwill or the capital reserve, whichever is more, should be shown on the. If there's a goodwill is more, it will come on the asset side of the balance sheet. If the capital reserve is more, it will come on the liability side of the balance sheet. Both should not appear in the balance sheet. Either the goodwill or the capital reserve, whichever is more, should appear in the balance sheet. I will repeat, goodwill or capital reserve item is there. If the goodwill is more, then the capital profit, goodwill appear on the asset side of the balance sheet. If the capital profit is more than the goodwill, it's called capital reserve, that will come on the liability side of the balance sheet. Both should not appear in the balance sheet. This is a major important point. Now, I'm going to explain about the vertical column of the balance sheet. So, how the balance sheet will apply here. So, now this year, you have to prepare the balance sheet under vertical column only. First one, shareholders fund, share capital of H Limited, then profit and loss of H Limited, add revenue profit, general reserve of H Limited, add revenue reserve should be added, then non-current liability, long-term borrowing should be shown, then you have to show the minority interest, current liability, creditor minus mutual mean, whatever the creditor we have got now, if both the companies has got, before that they have to pay that. Now when they become one and the same, so they become the mutual credit. Both the creditors of the H Limited and S Limited should be added. Whatever given in the adjustment, there's a mutual adjustment should be deducted in case of creditor, in case of BP. So here, shareholders fund, share capital of the holding company, profit of the holding company, add the revenue profit, general reserve of the holding company, add revenue reserve, then non-current liability, long-term borrowing, minority interest, then current liability, creditor. So creditor of H Limited, holding company, creditor, yes, both should be added. Whatever given in the adjustment is a mutual adjustment. Before that, they are the debtor, they are the creditor. Once they become one and the same, there is no question of debtor, there is no question of creditor. They should be rejected. It should be rejected. Both the creditor and in the debtor also they should be rejected. Regarding the BP and BR, deducted from BP, deducted from BR. Add both the BR deducted, add both the BP deducted from mutual adjustment among the holding company and the subsidiary company. So you have to prepare only on the vertical column only. This format you have to follow. Regarding this asset side, non-current asset, fixed asset, tangible, building machinery, furniture, then intangible goodwill, non-current investment, current asset, stock, debtor minus mutual, BR minus mutual, cash at bank minus mutual. Here also creditor minus mutual, BP minus mutual. I will explain what is mutual is there. Then it will come. This way you have to be non-current asset, fixed asset, tangible building machinery, furniture, motor car, intangible goodwill and patents will come. Non-current investment, any investment is a current asset, stock, debtor mutual, BR mutual, cash at bank. Then here this word is there. If BR and BP appears in the adjustment, deduct BR on the asset side and BP on the life side. If the BR and BP is available in the adjustment, add both the BR, H Limited and S Limited, then deduct the whatever the BR available in the adjustment, that should be deducted as a mutual adjustment. If there is a BR is there or BP is there in the adjustment, add both the BR, deduct that amount, add both the BP, deduct, it's called mutual adjustment. If the BR is there also, if the BP is also there, no, add both the BR, deduct the adjustment amount, add BP, deduct the adjustment. It may be BR or BP. Then debtor and creditor appear in the adjustment, deduct from debtor on the asset side and creditor on the liability side. If any debtor and credit are available before adjustment, they are separate. So when they become one and the same, the question of debtor and creditor does not arise at all. Here also, the question of BR and BP only comes when they are separate. When they become one and the same, we say consolidated, we say both the H limited BR, S limited BR, both the BR should be added. Whatever the adjustment, that should be deducted from the asset side on the BR, on the liability side BP. In the debtor and creditor, both the debtor of the H limited, S limited should be added. Whatever is the adjustment, that should be deducted as a mutual adjustment. Debtor of H limited, debtor of S limited minus mutual adjustment on the asset side. Liability side, add creditor both H limited and minus mutual adjustment. So you should be deduct on the asset side from the debtor. You should be deduct on the liability side if it is available in the adjustment. If the BR is available in the adjustment, whatever the amount available, add both the BR, H limited and S limited, deduct the mutual adjustment. If the debtor and creditor, whatever may available, add both the debtor, add both the creditor, deduct the mutual adjustment. That's why we say the word called mutual. Here, debtor minus, both the debtor should be added, minus mutual, both the BR should be added, that's a mutual. On the liability side, both the credit are added, minus mutual, both the BP should be added, minus mutual adjust. So this will appear on the adjustment only. So understand this, if BR or BP, it may be BR or it may be BP, appears in the adjustment, add both the BR and deduct from the amount of adjustment. Add BP, deduct from the whatever available in the adjustment. Either the debtor or creditor, whatever we mean, both the debtor and both the creditor are added, whatever in the adjustment is there, they should be deducted. It's a law. That's called mutual adjustment. Before that, they are the debtor and they are the creditor. Once you purchase the share, there is no question of debtor and creditor at the say. So only mutual adjustment will be take place between the debtor and the creditors are considered. Hope before the purchase of share by the holding company, they are the debtor, others are the creditor. By chance, S limited has to pay the money to H limited. S become the debtor, H become the creditor. When they become one and the same, the question of debtor and creditor does not arise at all because they are one and the same. So there is a mutual adjustment regarding the debtor and creditor. There is a mutual adjustment between BR and BP also there because they are one and the same. Before that, so some goods have been purchased by S limited. He has to pay the bills payable to whom? H limited. For H limited, so for S limited is a bills payable, for H limited is a bills receivable. When they become the one and the same, the question of BR and BP does not arise at all. Same thing, before that, who has to pay? S limited is a debtor, H limited is a creditor. When they become one and the same, the question of debtor and creditor does not arise at all. They are one and the same. So they are mutually accepted. They are the same content. So deduct from creditor whatever the amount available in the adjustment. Hope so. So so get fast now. Once again, a holding company is one which holds more than 50% of the shares of the another company, which contributes the other company having major voting rights and which controls the board of directors. A holding company is one which holds more than 50% of shares of the other company. Other company is called subsidiary company. The major is called the holding company. Then easy to control over the company, easy to avoid, easy to make one policy, easy to increase the amount of capital. So whatever the profit available at the time of acquisition is capital profit. After acquisition, revenue profit. Whatever the reserve available at the time of acquisition, it is called capital reserve. After acquisition is called revenue reserve. Then minority interest, their share, minority share capital, their share of profit, their share of reserve, profit on revaluation, loss on revaluation, it goes to minority. The minority interest will appear on the liability side of the balance sheet. Cost of investment paid by the holding company for the minority share, the face value of the subsidiary company, assume that they paid 4,50,000, real value is 3 lakh, the excess amount is 1,50,000. Then we have got a capital profit, capital reserve, appreciation of profit means a capital profit minus capital reserve. If the Goodwill is more than the capital profit, then goodwill appear on the asset side of the balance sheet. If the capital profits are more than the goodwill, it shall appear as a capital reserve on the liability side of the balance sheet. So this is the format of the balance sheet. On the vertical column only, this time you have to go and the share capital of H Limited, profit of H Limited, this profit and loss, then revenue profit, profit of the H Limited plus revenue profit, general reserve of H Limited, add revenue reserve, non-current liability, long-term borrowing, minority interest, current liabilities. Then non-current asset, fixed, tangible, intangible, asset, if you have a depreciation, that should be reacted. Intangible asset, non-current asset, current is stock, debtor minus mutual, BR minus mutual, cash at bank. This is only an adjustment I told you regarding the BR and debtor. It will appear in the adjustment. Before that, they are separate. Once the the shares are purchased, they become one and the same. The question of debtor and creditor and BP and BR does not arise at all. Mutual adjustment will be made by the holding company and the subsidiary companies are considered. Hope you understand. So in this session, I've explained every point regarding the problems are considered. In the next session, we'll start the problem. We'll go with the problem. Whatever I explain now, in the tomorrow session, I am going to solve the problem according to this explanation. Till then, goodbye. Meet in the next class with a problem.